It's a cold morning in late 1930, somewhere in small-town America. There's a line outside the local bank. It's already wrapped around the block before the doors even open. Nobody in that line is shouting. Nobody is panicking. Not yet. They're just standing there quietly, waiting to pull their life savings out in cash. And here's the strange part. This bank hadn't done anything wrong. Its loans were fine. Its books were in order. By every normal measure, this was a healthy, well-run bank. It failed anyway, not because of bad decisions inside the bank, but because of a rumor outside it. A whisper that maybe, just maybe, this bank couldn't pay everyone back. And once enough people believed that whisper, it stopped mattering whether it was true. Because here's something most people never learn about the Great Depression. The stock market crash of 1929 didn't destroy the American economy by itself. What turned a bad recession into the worst economic catastrophe in modern American history was something far quieter, far more human, and honestly, far scarier. Thousands of ordinary people, all making a perfectly reasonable decision at the exact same time. To understand how a rumor could take down a real, functioning bank, and then take down 4,000 more just like it, we have to go back to the 1920s, to a banking system that was, by design, a disaster waiting for an excuse. In the 1920s, the United States didn't have a handful of giant nationwide banks the way it does today. It had almost 25,000 of them. Tiny, independent, single-branch banks scattered across nearly every town in the country. A bank in Iowa had nothing to do with a bank in Ohio. If the Iowa bank failed, that was Iowa's problem alone. This wasn't an accident. American law had long restricted banks from opening branches across state lines, partly out of a very old fear that a handful of powerful Eastern banks might come to dominate the whole country. So instead, America built a system of thousands of small, fragile banks, each one a single point of failure. Compare that to Canada, right next door. Canada allowed nationwide branch banking, so it entered the 1930s with about 10 large, diversified banks. Through the entire Depression, Canada had zero bank failures. The United States, with its 25,000 small banks? A different story entirely, one we're about to watch unfold. Most of these small American banks survived on a delicate trust. They took in deposits from farmers and shopkeepers, then loaned that same money back out to other farmers and local businesses. It worked fine, as long as everyone didn't ask for their money back on the same day. And that's the piece most people miss. Banks never actually hold on to all the cash you deposit. They lend most of it out. That's the entire business model. It's called fractional reserve banking, and it depends entirely on one quiet assumption, that depositors trust the system enough not to all show up at once. In the booming 1920s, that trust held. Then came October 1929. You've probably heard of the stock market crash of 1929, Black Thursday, Black Tuesday, fortunes wiped out in a matter of days. Here's the part that surprises people. The crash itself didn't cause the Great Depression. It caused a serious recession, the kind the economy had weathered before in 1907 and 1921. Painful, but survivable. What changed everything was what happened about a year later, in a bank with a very unfortunate name. In December 1930, a large bank in New York called, of all things, the Bank of United States collapsed. It sounded official. It sounded federal. Depositors across the city genuinely believed this was a government institution backed by Washington itself. It wasn't. It was a private bank that simply chose an impressive-sounding name. When it failed, it wasn't just one bank going under. It was, at the time, the largest bank failure in American history. And it planted a seed of doubt in millions of minds that had never questioned their local bank before. If a bank that sounded like the United States government itself could collapse, what did that say about the small bank down the street? That single question was the spark. And once people started asking it out loud, the answer didn't matter anymore. The asking was enough. Here's where the story turns from a financial problem into a psychological one. And this is the part worth sitting with, because it explains almost everything that follows. A bank run doesn't require a bank to actually be in trouble. It only requires enough people to believe it might be. Think about it from an ordinary depositor's perspective in 1931. You don't have access to your bank's balance sheet. You can't verify whether your money is safe. All you have is a rumor and a decision to make. Trust the rumor is wrong and do nothing, or trust the rumor might be right and get your cash out today before your neighbors beat you to it. If you're wrong and you withdrew for nothing, you've lost almost nothing. If you're wrong and you didn't withdraw, you could lose everything. Rationally, withdrawing is the safer bet for you. The problem is everyone else is doing the same math. And when everyone acts on that same reasonable fear at the same time, they create the exact disaster they were trying to avoid. The bank, which only ever kept a fraction of deposits on hand, runs out of cash. Not because it was mismanaged, but because it was never designed to survive everyone asking for their money on the same Tuesday. This is what economists call a self-fulfilling panic. Nobody has to be lying. Nobody has to be wrong. The fear itself becomes the cause, and it spread fast. In May 1931, Austria's largest bank, Creditanstalt, collapsed under its own version of this pressure, and the panic didn't stay in Austria. In an interconnected global financial system, fear travels internationally almost as easily as money does. American banks with European ties felt the tremors within weeks. Across the United States, waves of bank runs rolled through 1931, then 1932. Small banks failed by the hundreds, then the thousands. By the time it was over, more than 9,000 American banks would fail during the Depression, wiping out the savings of millions of families who had done nothing wrong except trust the wrong institution at the wrong moment. Here's a fact that historians still debate the full weight of, but broadly agree mattered enormously. As banks failed, they didn't just lose deposits, they stopped lending. Money that used to circulate through farms, factories, and shops simply vanished from the economy. Some economists, most famously Milton Friedman and Anna Schwartz, argued decades later that the American money supply shrank by roughly a third during this period, turning a recession into a catastrophe. Other economists place more emphasis on collapsing spending and wages rather than the money supply alone. What almost everyone agrees on is this: the banking panics didn't just reflect the Depression, they deepened it. And in Washington, the response was, to put it gently, not built for this moment. President Herbert Hoover believed deeply in limited federal intervention and voluntary cooperation between businesses. His Treasury Secretary, Andrew Mellon, reportedly advised, according to Hoover's own later memoirs, to simply let the crisis burn itself out. Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, and let the weak be purged from the system. It's worth pausing on that advice because from the outside, in hindsight, it sounds almost cruel. But at the time, this reflected a genuine, widely held economic belief that downturns were self-correcting and that government interference would only prolong the pain. It had, after all, mostly worked that way in previous recessions. This time, it didn't. By early 1933, the panic hadn't burned out. It had reached the entire country. By February 1933, in the final weeks of Hoover's presidency, the banking system was no longer experiencing isolated panics. It was in a full nationwide collapse. State after state declared its own emergency bank holidays, shutting banks down just to stop the bleeding. Cash was disappearing from circulation as people hoarded what little they could still withdraw. The country was, quite literally, running out of functioning banks on the day Franklin Delano Roosevelt took the oath of office, March 4th, 1933. In his inaugural address, Roosevelt said the words most people still remember: "The only thing we have to fear is fear itself." It's easy to hear that as an inspirational line, but given everything we've just walked through, it was something closer to an accurate economic diagnosis. Fear wasn't just a feeling. It was quite literally the mechanism that had been dismantling the banking system for 2 years. 2 days after taking office, Roosevelt did something no president had done before. He declared a national bank holiday, closing every single bank in the country for 4 days. Congress rushed through the Emergency Banking Act to give federal examiners time to determine which banks were actually sound. Then, on March 12, 1933, Roosevelt did something arguably more important than the holiday itself. He spoke directly to the American public over the radio. the first of what became known as his Fireside chats, and explained in plain language exactly what the government had done and why it was now safe to put money back into reopened banks. It was a strange kind of experiment. Could you cure a panic by simply talking to people honestly? When the banks reopened the following day, something remarkable happened. Deposits flowing back in outweighed the withdrawals flowing out. People who had been pulling cash out of banks just weeks earlier were now lining up to put it back in. The tool that had destroyed thousands of banks, collective belief, turned out to be exactly what could save the rest of them. Restoring confidence stopped the bleeding, but Roosevelt's administration understood that trust alone wouldn't prevent the next panic from happening all over again. So in June 1933, Congress passed the Banking Act, better known as Glass-Steagall, which did two things that reshaped American finance for the next 50 years. First, it separated commercial banking from the riskier world of investment banking so that ordinary deposits wouldn't be exposed to Wall Street speculation. Second, and more importantly for our story, it created the Federal Deposit Insurance Corporation, the FDIC. For the first time, the federal government guaranteed that if your bank failed, your deposits up to a set amount were safe regardless. Not because the bank was trustworthy, because the government now stood behind it. The effect was almost immediate. In the years after FDIC insurance began in 1934, bank failures dropped from thousands per year to a small handful. The self-fulfilling panic that had spread across America for 4 straight years essentially had its fuel removed. If depositors knew their money was safe no matter what, there was no longer a rational reason to run to the bank first. It's a strange kind of solution when you think about it. The Depression wasn't only solved by fixing banks. It was solved, in large part, by fixing what people believed about banks. That single insurance guarantee, a promise backed by the federal government, is still sitting quietly underneath every American bank account today, nearly a century later. Every time you see member FDIC printed on a bank's window or website, you're looking at a policy invented specifically because of what happened between 1930 and 1933. It's one of the most successful, least glamorous pieces of financial infrastructure in American history, precisely because it works so well that most people never think about it at all. But the lesson underneath it is bigger than deposit insurance. It's about how modern financial systems actually run on belief as much as on money. A bank, a currency, a stock market, all of them depend on enough people trusting the system enough not to test it all at once. And that lesson hasn't stayed safely in the past. In March 2023, a mid-sized California bank called Silicon Valley Bank collapsed within about 48 hours. Not because of a whispered rumor spreading through a line outside a building, but because of a modern version of the exact same panic, spreading through text messages and social media at the speed of a phone notification. Depositors, mostly tech companies, tried to withdraw billions of dollars within a single day. The bank, like those small banks in 1930, simply didn't have that much cash on hand at once. It wasn't the Great Depression. Federal regulators intervened within days, deposit insurance limits were expanded for that specific case, and the broader banking system held. But the underlying mechanism, reasonable people, each making an individually rational decision, together creating an outcome none of them wanted, was exactly the same one that tore through American banks nearly a century earlier. Here's what's easy to miss about the Great Depression, buried under all the dates and statistics. It wasn't only a story about bad debts, or a crashing stock market, or failed harvests. It was a story about what happens when trust breaks, and how astonishingly fast that break can spread once it starts. The people standing in that bank line in 1930 weren't foolish. They weren't panicking without reason. They were doing something completely rational, one person at a time, and in doing it together, they helped create the very disaster they were trying to escape. Nearly a century later, we've built better tools to stop that particular kind of fear from spreading. But the fear itself? That's still just as human as it was in 1930, which might be the most useful thing this story can leave you with. Not a date, not a policy, but a question worth remembering the next time trust in any system starts to waver. Is the danger really out there in the world, or is it simply everyone believing at the same moment that it might be?